Hi, my name is Kanal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. What started off as a coffee chat has now grown into a global platform for visionaries. This morning from Hong Kong, we have the ex co founder of Liquefy and the current founder and managing partner of Newman Capital joining us today. Please welcome Adrian Lai. Adrian, thank you so much for joining us.
Thanks for the invitation.
And how are things with you over in Hong Kong?
Well, it's been great. Going to Singapore on 26th, and after Singapore, I'll be in Thailand, just looking at the ecosystem in Southeast Asia.
Let's jump into the first question, shall we?
Yeah, sure.
So, Adrian, tell me about yourself and your background and how it led you to the path of starting Newman Capital.
Sure. So I was born and raised in Hong Kong, and right after my graduation in 14, I joined BlackRock in the asset management space. So I was in several roles in private and retail bank marketing. I was in ESG investment, but in 2016, I decided to leave the TradeFi space and enter the crypto space. So before I start the company Liquefy, I actually was more in the prop trade in crypto, and I kind of learn a bit about Bitcoin and every altcoins in the 17 ICO space. So I did some ICOs, did some secondary market trading. The kind of the breakdown of ICO made me rethink a lot about institutional crypto or blockchain, whether it will be the go to market thing instead of just pure ICO at that time. So I started the company Liquefy, which is really in enterprise blockchain solution space. So we offer blockchain solutions to whether it's real estate companies or banks for them to mainly tokenize their asset. And in 2019, I caught up with the whole crypto space, and I think it went much more mature than the ICO time, where you could raise a lot of monies with just a blank idea or a white paper. And I look at DeFi because I was in the financial space quite a bit, and I look at DeFi, and I decided should start investing more into the Web3 space. Web3 just basically everything related to decentralized finance, gaming, whatever. So I started Newman Capital as an investment arm to invest in the Web3 space, but obviously before that, I actually focus a lot on private equity stuff, but probably much less irrelevant for today's conversations.
And at Newman Capital, what have been some of the most exciting investments to date?
Well, I think we did quite a bit. So we invest in, as I mentioned, not just Web3, we invest in private equities in projects like, not projects, but companies like SpaceX, Reddit, Epic Games, which I really like a lot because I'm a fan of Fortnite. And we also invested in companies like Dapper Labs, Yuga Labs, the parent company of Bored Ape. But exciting things that I'm looking at recently, and we did investment too, is very early stage as well. One is called Subera, is a payment infrastructure protocol which allows any Web3 users to pay through subscription models. So basically, in Web2 world, you can pay to services like Spotify through a subscription model on a monthly basis. Now through Subera, is chain agnostic, and you can pay with a subscription model every month or every day, or you can even do a one-time payment as well. So I feel like if consumer facing is the main thing, or Web is gonna having a lot of consumer-based activities, subscription model will be a thing. Another one that I really like recently is a company called Enfine, which is a Vietnam-based Robinhood equivalent. We talk about YC just now, and we actually screened this company out of the Y Combinator cohort as well. So the reason I like them is because I'm personally really interested in the Vietnam market with the growth engine, obviously with the kind of user behavior very similar to what we're looking for in the Web3 world. But this company now just do purely stock trading, and I will be very eager to look at them entering the crypto market in the future.
So, going off this point, it is my understanding that you are looking at a lot of companies which are involved in DAOs. Why is that, and where do you see the future going with it?
Well, I think DAO is a tricky topic because, well, and I think it is also a matter of how much decentralization plays a role. I saw that when that was kind of developed in 17, there's a lot of extreme situation that you could people can raise a fund in a DAO format, and every member has a say in terms of what kind of things to invest in with a so-called DAO, but there's no protections on the members, which a lot of regulators don't like. And there are DAOs, they are super centralized, and it is just using DAO as a kind of terms to attract people to join it, but essentially is a fund per se. So I think DAOs, there are several types of them, could be interesting in the future. Investment DAO wise, I personally am not a fan of it. I think something like a social DAO, which you have to perform certain activities, or you could have own certain stuff like NFTs, so you could have a right to join that DAO to communicate or socialize with other members. And obviously, social DAO comes with an objective on what kind of things you want to achieve within a DAO, whether it is, it could be talking about collecting watches, you could be talking about art, etc. There's also services DAO is growing really rapidly as well. Some with sub DAOs under a DAO, which could carry out or perform any actions that is probably better than a centralized organizations. So decentralized auditing is something I'm looking at as well, how you can have group a bit of some talents together and perform auditing for code instead of just relying on centralized organization to do it. But I think overall the DAO space is developing really interestingly because it's something, it basically fulfill the premises that Ethereum or in general blockchain want to achieve from the early days.
When it comes to the future of DAOs, it seems that many companies really blend it in with this play to earn or move to earn model. Can you talk more to that?
Well, I think it is the X to earn model was something developed when XC Infinity was so popular back last year, I think. Well, I feel like whatever to earn model is, I wouldn't say it fails, because it's something that really innovative. I think it takes time to develop and for the market players to optimize the model. But something like a XC or something like a Steppen, they did learn their lessons, I guess, when they developed the business model or the tokenomics, which usually include an indefinite token supply for one of the tokens. And well, I think whether it is play to earn, whether it's play to own, whether it is whatever free means kind of model, at the end it comes back to the gameplay itself. So whether it is whatever kind of mechanics that you use to incentivize people to either own the tokens, earn the tokens, or to use the platform, it goes back to whether the game itself or the application itself is interesting enough for growth hacking. So I think that matters. But instead, during the bull market, a lot of people just focusing on how to design the tokenomics and forget the real fundamental underlying.
And speaking of Axie, when it comes to looking at both Axie and Steppen, do you find the tokenomics to be, in a sense, a well-played Ponzi scheme? I mean, a lot of people out there, there are believers who believe in the industry, but there are a lot of projects out there that are a Ponzi scheme, but are tackling it from this play to earn perspective that when the tokens run out, what happens to the game?
Well, it's funny. So when I the first time that I experienced something really Ponzi was in 17. I was one of my friends kind of tricked me into a game called FOMO 3D, which is a game on EOX, and it's a pure Ponzi. you basically refer someone to play the game. You earn a split of the referral fee. So it's a traditional classic Ponzi. But coming to XC and STEPN is a more advanced of XC for me in terms of gameplay and everything for growth hacking. But the tokenomics itself actually doesn't improve a lot from XC to STEPN. I feel like as I mentioned, the indefinite, even though there's a designed indefinite token supply for whether it's SPL in XC or the GST in STEPN. The thing is, when the gameplay is not good or well thought, the users and players will just try to earn the tokens and dump it in the market instead of using the tokens for pre-designed mechanisms or functions. So, for example, in XC, as I recall, you can use SPL and combining with a certain number of AXS to kind of reproduce another axis or kind of develop an axis. But I feel like whether it's a marketing angle or the real user behavior, incentivize them to just sell the SPL for earnings. Or sometimes selling the NFT for earnings is fine, but I guess everyone just farm a token to sell it. So I don't think it is. They are probably being criticized as Ponzi now for XC and STEPN, but going forward, I see kind of a lot of players trying to optimize how they design, how they work with the tokenomics. To be fair, STEPN and XC were just very early players, and I see that even STEPN now is trying, the founders or the team is trying to think of a lot of different gameplays or mechanics or ways to utilities for people to use GST instead of just having users dumping right all the tokens in the market. So I see some development happening, but I would need time to look through it myself and digest it through the bear market.
And speaking of the bear market, what type of solid fundamentals do you believe should be established during a time like this for startup founders building and venture capitalists investing?
Well, I think the question is split into two parts, especially for founders versus venture capitalists. And talking about VCs first, I have a very strong viewpoint, in particular when we introduce some of our portfolios to other VCs. I realize in Web3, a lot of VCs talk about the market timing. So basically, if you, for example, I was introducing an NFT financialization project to some of the VCs, and they would say the market is not ready for this, something like along the line. But I feel like any VC should invest in the future instead of looking at the market timing now. So if you think the market is the fit for NFT financialization now, the valuations probably has skyrocketed already. So you're kind of investing in what should be the next thing in the next cycle. So I think VCs should revisit the fundamental of the investment thesis during the bear market, meaning that what do you think that matters really in Web3? A lot of people invest in gaming, especially in titles. And I would criticize that, in terms of gaming and titles, how much does the valuations, is the valuations derived from really Web3 stuff instead of just pure gameplay? You don't see a Web2 games raising a 500 million valuations, even they have a really strong team and developers and nice gameplays. But in Web3 games, you often see 100, 200 million valuations of projects, but just because they have a token themselves. So I think VC should definitely revisit what they really believe in and the fundamentals during the bear market. For project founders, I feel like obviously they have to think about what is the thing that matters to them in the bear market, or overall what is the belief in Web3 for them. But usually for Web3 founder, they're already very convicted in certain areas they want to achieve. For example, they might want to do something in gaming. I think the fundamental side of for a project founder is to actually not just learn about the macro and talk to VCs, but really understanding about the industry without the Web3 thesis. Because I see a lot of founders entering Web3 space, graduate, young people that have not got a lot of working experience, and that's that's all good because that is the ages with a lot of entrepreneurship. You have a lot of ideas floating around, but some of the Web3 is very tricky in the sense that you have DeFi, you have, whether it's prediction market, whether it's social, a lot of them actually comes with, you need to have the background of those industries in order to be successful and transforming the industry Web3. So I would really think that Web3 founders should get at least a fundamental knowledge in the sub-industry they're working in, whether it's financials. If you are working something in terms of DEX or derivative protocol, it is nonsense that don't have idea of the underlying financial economics. So I would strongly suggest them to go back to fundamentals.
And when it comes to looking and making an investment, especially from the venture capital side, and you're looking at valuation and revenue metrics, how does one go about valuing tokens? I mean, depending on business model, it's either an intangible asset, some sort of inventory, or some companies just directly recognize it as revenue. It depends on whether it's the issuer or the person buying the tokens as well.
Well, I think it is a very interesting question because I actually internally, over the past several months, we had that debate because we were trying to look for opportunities in secondary market, and obviously valuation comes down a lot from a relative market cap perspective, but we were also looking for indicators or multiples that could point us to the right direction or right projects. So, for example, Uniswap, before, obviously they are discussing internally. Not internally, but in a public forum in terms of giving back fees to uni holders, and kind of like a dividend. But before having this proposal, I think most of the fees actually go to liquidity providers, and we were just debating internally on if we're looking from a TradFi perspective, whether this a fee providing liquidity provider is kind of account as cost of goods sold instead of, how does it play with whether it is a cost of goods sold, whether it is actually accounted still as a revenue or something like that. And Uniswap, if we're looking from a TradFi perspective, actually doesn't come with net earnings. So it is really expensive you're comparing with the tech companies. And that's sort of why when we look at more and more protocols like Uni or even DYDX, especially we were looking at DeFi protocols, we come to a conclusion that it is not the right time to look at any revenue or earning multiples. Even though I know a lot of these third-party providers provide this data, but to us it is just guiding metrics. Instead, we think that the Web3 space, whether it's a DeFi or gaming or other, whether you are a DAO, I think it's like a 2011 or 12 Facebook kind of thing. Kind of timing that you have to look at the growth metrics, like the number of users activities, and which matters the most before we talk about net income or earnings. I don't think the market is ready for that. So now when we look at the portfolios or any kind of companies, we want them to go aggressive on user acquisitions. Obviously, it's not really just focusing on tokenomics or Ponzynomics to recruit users. It's really about not just the gameplay, but we go to a DeFi protocols. It's fundamentally how you have a sustainable system to attract users to use the product with a sustainable yield. Definitely not like an Anchor protocol of Lunar. But the user side of metrics is what we're looking at, and the on-chain activities of those users. How often do they use the protocol? How often do they trade? What is the size of trading? Do they go long or short more frequently? We tend to look at this more than earning or revenue multiples after we have the kind of a look into multiple DeFi protocols for ourselves.
So Adrian, given this, where do you see the next big move for crypto?
As a Newman Capital, we had views on the next big thing. I don't think it's necessarily right, but we like two space. The first one is the Web3 social space, and the second is the NFT financialization space. And I'll kind of elaborate for both of them. Web3 social, I think we form a thesis that the current wallets or any kind of messenger apps, and usually wallet like MetaMask or other kind of MetaMask equivalent, should have the role of people trying able to socialize with each other. But the wallet itself, currently MetaMask, just purely serve as a wallet, pure wallet. But we believe that anyone with a wallet address and owning kind of like a wallet to do payment transfer should be able to do any kind of social activities as well, whether it is owning an NFT avatar, whether it's to DM others, to socialize with others, whether it is having notification functions in case something happening. For example, if another person on your contact list bought the NFT, it should be pop up with notification. So I think social, however, we do not believe in any decentralized Twitter, decentralized Facebook, decentralized Instagram per se, because we think the market still is leaning towards using Twitter and Facebook and Instagram because they are still the norm. So we think that any kind of ways to add on the social element on top of existing Web3 solution being used will be great. Will be great for the next wave, especially when I focus a lot on consumer journey and user acquisitions, explosion in growth of users. I think social is something that we should be looking at. So the second is NFT financialization, and that's something we like, and I think there's kind of like a debate out there whether it will flourish or not. And we saw pseudo swap being so popular recently, kind of like a Uniswap equivalent, but we are interested in a derivative space of NFTs. Whether you are able to do long short of a Bored Ape, whether you are able to hedge against the position of your other side landed as well. I think when NFT and as an asset goes more have a stronger growth, the financialization of derivative side of things should develop, and ultimately how it brings on to the real world asset market, whether it is physical art market, is something that I'm personally really interested in and trying to break the puzzle or create or solve the issue for several years. But I think it takes a bit of time. But so far, I think financialization of NFT would be something I'm really interested in, and I saw several market makers already entering a space trying to create liquidity.
So Adrian, when taking a step back and looking at the crypto market from a macro perspective, how should one look at pricing Bitcoin and Ethereum compared to potentially being the next gold equivalent?
Personally, I'm quite against the comparisons of Bitcoin and Ether versus digital gold, because I know it's a norm to say that, and back in several years of time, we always talk about the inflation hedge for Bitcoin, and Ether has always not been a digital gold comparison. I think it's very much you investing in Ether. In the past several years, investing in Ether is kind of like an equity play, but now it's getting much more complicated after the merge, that you have to consider also the yield perspective, the kind of emission schedule whatsoever. But it definitely not gonna be compared to digital gold. But overall, I think Bitcoin itself is, I hate to say that, but I think the pricing is irrelevant to what I say. I think Bitcoin is an old dinosaur in crypto space. It has to remain. There's a reason for it not to advance technologically because of its decentralization. But I feel like Ether will definitely flip Bitcoin, given how much functionalities and how much role it has in Ethereum and Ether have in terms of the Web3 development. But overall, it is definitely not going to hedge against inflation like gold does, because of how much correlation Bitcoin and Ether have with the macro market. As we see last several months, even we take out the merge effect or the implications on Ether price, both Bitcoin and Ether are not kind of following gold price. It is very much related to S&P 500 pricing, and it's just gonna be getting worse because of how much institutions or hedge fund traders are being involved in the market. So I think the narrative of digital gold is already done, and Bitcoin and Ether will have its own curve after the macro market stabilize, I guess. But I think the correlation wouldn't just come down suddenly, and that's sort of people just have to accept that it's no longer inflation hedging tool.
So, Adrian, to wrap up our call with the last question for the day, what piece of advice would you give to people out there from the journey you've had so far in life?
Well, I think there's in whatever industries and whether it is in Web3 or not, you have to be passionate yet managing risk. And when I say that, is obviously being passionate in what you do is very important. And if you're in Web3 space, your kind of passion has to be much bigger than joining other industries, because the Web3 space is growing so rapidly and is so interconnected among industries. But it's very easily understood for being passionate, but managing risk is another thing. And when I say managing risk, it doesn't equate to being risk averse or not taking risk. So personally speaking, I am, even though how much I love about the degenerate space in Web3 or overall crypto, or even overall now the financial market, people kind of go all in every day. And I see you could get so rich in one day, and you can get so poor or broke in one day. Being managing risk is just is something that you could do after you understand fully the whole picture of something that you're working on or you're reading. And for me, I tend to be kind of managing risk all the time. I think that is much more difficult than going all in something, because you need to leave you need to basically leave your bullets to continue with what you're passionate with, or kind of if the market goes down, or if something that you're working on just goes completely wrong, at least you have the bullets to do other things that you're passionate about in your life. And I think managing risk, more importantly, is allow you to have a peace of mind, because I see traders around me losing or earning a lot of money, having a cycle which is lots of up and downs in several months, but turns out their life might not be happy. And at the end of the day, having a peace of mind is very important for long-term development of yourself, because you just have to be happy.
Well said. And for people out there who are interested in catching a cup of coffee with you in person or doing a Zoom call, what would be the best point of contact?
Well, you can always reach out to me on LinkedIn or Twitter. Just search Adrian Lai. You can reach out to me on LinkedIn or Twitter, and you can also reach out to me through email, which is adrian@newmancapital.com. I'm always happy to do coffee, Zoom call, whatever. I travel all the time as well since the border opens in Hong Kong. So looking forward to talk to you guys.
Adrian, it was a pleasure having you on Geeks of the Valley, and thank you so much for joining us today.
Appreciate it. Thanks a lot.
This podcast is brought to you by Python, an Asian-based open source enterprise software company. Python offers a suite of software applications and infrastructure services to scholars and universities.